Right now, governments and regulators around the world are rewriting the rules of banking, and most people have absolutely no idea it's happening. The changes I'm going to walk you through today are already making wealthy individuals rethink where they keep their money and how they structure their finances. There are 11 rule changes generating the most anxiety right now. I'm Dre, and I'm going to break down exactly what's shifting, which of these changes actually matter to you, and the steps you can take to keep your money safe. But before we get into it, let me be really clear about something. This is not a fear video. I'm not here to push conspiracy theories or cause unnecessary panic. What I am here to do is help you understand how modern banking actually works and why so many financially savvy people are genuinely alarmed by the direction things are heading. So let's get straight into it. Rule number 1. Most people believe that if their bank collapses, the government will swoop in with a rescue package. And for roughly the last century, that was essentially how it worked. But the 2008 financial meltdown changed everything. Governments around the world pumped trillions into failing banks, and taxpayers were left carrying the weight. After that experience, regulators globally decided they needed a completely different approach. That's how we ended up with something called a bail-in. Here's how it works. Rather than using public money to rescue a failing bank, regulators can now use money that's already sitting inside the bank to absorb the losses. The order typically starts with shareholders, moves to bondholders and debt holders, and can eventually reach large depositors whose balances exceed the insured limits. And those limits are lower than most people think. In the United States, deposit insurance covers $250,000. In the European Union, it's 100,000 euros. The United Kingdom covers 85,000 pounds, and Canada insures 100,000 Canadian dollars. Anything above those thresholds is considered unsecured, meaning it can legally be tapped to stabilize the bank during a crisis. This isn't hypothetical. Bail-in frameworks are already law in the US, the EU, Canada, and a growing list of other countries. Rule number 2 catches a lot of people off guard because it has nothing to do with bank failures. It's about what happens when you stop using an account. In most countries, if a bank account goes untouched for a certain period, it gets classified as dormant. And once that label is applied, something known as escheatment law kicks in. These laws allow the government to take control of those unclaimed funds. Depending on where you live, this can happen in as little as 3 to 5 years of inactivity. Now, the bigger concern isn't that these rules exist, it's that the timelines are shrinking. Australia cut their dormancy window from 7 years down to 3 for many types of financial assets. The United Kingdom expanded their dormant asset scheme beyond just bank accounts to now include investments and insurance products. And across the European Union, there are active discussions about standardizing dormancy periods across all member states, which would likely push everyone toward a shorter time frame. Rule number 3 is one that most people only associate with criminal cases. The assumption is that authorities can only take your assets after you've been convicted of a crime. But in many developed nations, that's simply not how it works. Through civil asset forfeiture, governments can seize property and freeze bank accounts without ever securing a conviction. In the U.S., this happens regularly under both federal and state law. The United Kingdom has what are called unexplained wealth orders, which operate on a similar principle. Australia and Canada both have proceeds of crime legislation that functions the same way. While these mechanisms were originally designed for organized crime and corruption, the legal bar for freezing assets is often much lower than people realize, and accounts can stay frozen for extended periods while cases drag on. Rule number 4. When this one gets triggered, it doesn't just affect you individually. It hits everyone in the country at the same time. Your ability to withdraw money gets limited. International transfers get blocked or heavily restricted. Converting your funds into foreign currencies becomes nearly impossible. This is what capital controls look like. A lot of people think this only happens in unstable developing economies, but history says otherwise. When Cyprus faced its banking crisis in 2013, the government imposed strict withdrawal limits and froze international transfers for months. During the Greek debt crisis, daily ATM withdrawals were capped at just €60. And in Iceland, after their banking system collapsed, capital controls stayed in place for nearly a decade. The critical takeaway here is that while your money might technically still be in your account during capital controls, actually accessing it becomes extremely difficult. And once controls are imposed, it's too late to move your funds. The window to act is always before a crisis hits, not during one. Rule number 5 shifts away from crisis scenarios and focuses on what you're permitted to do with your money under normal circumstances. Governments are increasingly introducing regulations that limit how citizens can hold or invest in certain asset classes. American investors, for instance, face incredibly complex tax treatment when holding foreign mutual funds. The United Kingdom has floated proposals to cap individual exposure to stablecoins. And globally, regulators are tightening reporting requirements around cryptocurrency holdings, foreign currency accounts, and even physical gold transactions. These policies are typically framed as necessary for financial stability or anti-money laundering compliance. But the practical effect is that governments are increasingly dictating how you can allocate your own wealth. Rule number 6. This is a major one, and it's unique because it isn't being driven by legislation directly. It becomes a problem when central banks print money faster than the economy grows, which erodes the purchasing power of your savings. That's currency debasement. When inflation outpaces the interest your deposits earn, you're losing real value every single day. But the deeper concern right now is what comes next. Many central banks are actively developing central bank digital currencies, or CBDCs. These are digital versions of national currencies issued directly by central banks, and they open the door to monetary tools that don't even exist yet. We're talking about programmable money, where spending could be restricted by category, stimulus payments targeted to specific demographics, or even negative interest rates applied directly to your holdings. Unlike the other changes we've discussed, which are already law, the full implementation of CBDCs is still being debated. But the mere possibility of this level of control over money is enough to make a lot of people start diversifying internationally. Rule number 7 gets into sensitive territory because it involves tax authorities. Every developed country gives its tax agency the legal power to freeze bank accounts, typically over unpaid taxes. And through international agreements like FATCA and various information exchange treaties, tax authorities can now pursue assets across borders. What concerns a lot of people isn't the existence of these powers, it's how aggressively they're being used. Even individuals who pay every dollar they owe and file everything properly are finding their accounts frozen overseas while authorities investigate their international financial activities. This isn't about tax evasion. It's about the fact that aggressive enforcement actions can lock up your funds even when you've done nothing wrong. Rule number 8 is something you may have already experienced without knowing it. Every bank operating today is required to monitor account activity under anti-money laundering regulations. In the U.S., banks file suspicious activity reports. Canada uses FinTrack. Australia has AUSTRAC. The UK and EU have their own equivalent systems. These reports can be triggered even when your transactions fall below formal reporting thresholds. The notion that keeping transfers under $10,000 keeps you off the radar is simply not accurate. What's changing is the technology and scope of this monitoring. Most countries are shifting toward behavior-based surveillance using artificial intelligence. Banks are also sharing client information with each other at an unprecedented level. In some cases, accounts get temporarily frozen while compliance teams conduct reviews. And these investigations can drag on for years even when no wrongdoing is ever found. Rule number 9 involves something called de-risking, and it's been accelerating over the past several years. This is when banks close accounts not because the client did anything wrong, but because the bank has decided the client's profile carries too much perceived risk. This tends to happen to people who send frequent international transfers, operate cryptocurrency-related businesses, hold political positions, or have connections to certain countries. Rather than investing the time and resources to properly evaluate whether a client is legitimate, many banks simply terminate the relationship. It's cheaper and easier for them. The result is that people with perfectly legal and transparent financial lives are losing their banking access. Rule number 10 is already impacting millions of people across developed countries. Governments are placing aggressive restrictions on the use of physical cash. France, Spain, Greece, and the Netherlands have all introduced strict caps on cash transactions. And while the legal restrictions are concentrated in Europe, the practical disappearance of cash is happening everywhere as banks and payment processors make it increasingly difficult to operate with physical money. Rule number 11 ties everything together. When you look at all of these changes collectively, what you see is a steady move toward greater government control over private wealth. Each individual rule might seem reasonable in isolation, but together they create an environment where your access to your own money is increasingly dependent on government policy, banking compliance decisions, and regulatory whims. The people who understand this are already taking steps. They're diversifying where they hold their assets. They're exploring jurisdictions with stronger protections for depositors and asset owners. They're making sure that no single government or banking system has complete control over their financial life. Now, I'm not telling you to do anything drastic or to act out of fear. What I am telling you is to educate yourself on how these systems work so that you can make informed, strategic decisions about where your money sits and how it's protected. The people who get caught off guard are always the ones who assumed the rules would never change. Don't be one of them. Knowledge is the best financial protection you can have. If you found this breakdown valuable and want to stay informed on changes like these as they develop, make sure to hit that subscribe button so you don't miss any future updates. I'll see you in the next one.